Did you know a rogue trader single-handedly collapsed a 233-year-old Barings Bank where Queen Elizabeth II was an account holder in 1995? Or maybe you didn't know that were 568 bank failures from 2001 through 2024. Well, these facts pale in comparison to the top 15 craziest corporate frauds and scandals in history. Today, we uncover the outrageous stories of CEOs who went from boardrooms to jail cells. You won't believe what they did with the money they stole. From luxury mansions to golden parachutes, these CEOs weren't just greedy, they were audacious. But behind the glamour was a trail of deception, ruined lives, and billions of dollars in stolen wealth. Stick around as the Downfall Diaries reveal the most shocking tales of corporate greed, how they got away with it, and how it all came crashing down. Make sure to watch until the end. The last story will blow your mind. Sit back, grab a cup of your favorite drink as we plunge into the episode 1 of 5 in the series, The Biggest Corporate Frauds and Scandals in History. The visionary from Vienna, Markus Braun Wirecard. Markus Braun was born in 1969 in the historical city of Vienna, Austria, into a world where the fusion of technology and commerce was just beginning to take shape. From an early age, Braun showed an early knack for numbers and displayed an analytical mind with a fascination with systems. By the time he graduated with a degree in commercial computer science from the Technical University of Vienna, the seeds of his ambition were already sown and his sights set on transforming the digital world. In 2000, Braun earned his PhD from the University of Vienna, delving deep into the synergy between commerce and computation, a theme that would dominate his career. Braun wasn't content with following the beaten path. His early years as a consultant at firms like KPMG Consulting AG sharpened his skills, but Braun's ambitions far exceeded the confines of corporate life. He yearned for a venture where he could lead, innovate, and redefine industries. In 2002, he found his stage, a small, unassuming payment processing company called Wirecard AG, a little-known German payment processing company. Braun wasn't just joining Wirecard, he was about to reimagine it, building the Wirecard empire. As CEO and CTO of Wirecard, Braun transformed the company from a niche player into a global powerhouse. By the late 2000s and 10s, Wirecard, the fintech titan, was a darling of the financial world, a symbol of Germany's ability to compete in the tech sector. Braun spoke of Wirecard not merely as a payment processor, but as a digital ecosystem for global financial commerce. His pitch was irresistible. Wirecard wouldn't just process payments, it would redefine the global flow of money. With sleek presentations and a bold vision, he convinced investors that Wirecard was the future of payments. Under his leadership, the company expanded aggressively, acquiring businesses and positioning itself as the backbone of digital commerce as it secured its place on Germany's prestigious DAX 30 index, rubbing shoulders with giants like BMW and Siemens. Its stock skyrocketing as investors clamored to be part of the next big thing. Braun's futuristic vision and confident demeanor convinced stakeholders that Wirecard was the future of finance. At its peak, Wirecard's market value exceeded 20 billion euros, and Braun personally held over 7% of its shares, making him the largest shareholder. But as Wirecard soared, whispers of irregularities grew louder. The House of Cards. In 2019, whispers turned into headlines. Investigative journalists began to question Wirecard's meteoric rise and began scrutinizing Wirecard's finances. Where exactly was the money coming from? How did Wirecard achieve such staggering growth, especially in underregulated markets? Questions arose about the company's rapid growth, its reliance on third-party partners in Asia, and most damningly, the whereabouts of 1.9 billion euros, an amount Wirecard claimed was held in trust accounts but couldn't be verified. Braun dismissed the allegations, calling them smear campaigns orchestrated by short sellers looking to profit from Wirecard's demise. He reassured stakeholders with his characteristic calm, insisting that the company's fundamentals were strong until the unthinkable happened. In June of 2020, auditors unraveled the truth. A gaping hole was discovered in Wirecard's finances. 1.9 billion euros was missing. It wasn't just misplaced, it likely never existed. Wirecard's accounts were riddled with inconsistencies, and the once mighty company filed for insolvency. The fall. On June 18, 2020, Markus Braun resigned from Wirecard. 4 days later, he was detained and arrested in Munich, charged with accounting fraud and market manipulation. The man who had once been lauded as a visionary now stood accused of orchestrating one of Europe's largest corporate scandals. Prosecutors alleged that Wirecard's success was built on a web of lies. For years, the company had fabricated transactions to inflate revenues and secure loans with doctored financial statements, masking the missing 1.9 billion euros in an elaborate scheme to deceive investors, regulators, and the public. But Braun maintained his innocence, claiming that he too was a victim of deception by others within the company. As the scandal unfolded, Braun's reputation as a visionary vaporized, replaced by the image of a CEO who had orchestrated the deception himself. Wirecard's collapse was a tsunami in Germany's financial and political landscape, raising questions about regulatory oversight and corporate governance. The trial of Markus Braun. In December 2022, Braun's trial began in Munich. It was a spectacle. The courtroom became a drama stage. As the prosecution painted Braun as a mastermind who oversaw years of deceit, the defense described him as a visionary blinded by trust, betrayed by those he had relied on to manage the company's finances. The courtroom drama grabbed the eyeballs of the public, not just for its legal stakes, but for what it symbolized: the fall of the face of Europe's fintech revolution. It exposed the nakedness of the broader fintech industry with its rapid growth and lack of oversight, a legacy of scandal. As of 2024, Markus Braun's trial continues, but he remains defiant, insisting that he is innocent and that the truth will exonerate him. He faces a potential for a 15-year prison sentence if convicted. This scandal is an earthquake that shook Germany's corporate landscape, leaving an indelible mark on the country's corporate reputation. Braun's story is a divisive one. To some, he is a visionary who lost control of his creation. To others, he is a calculated manipulator who built his empire on lies. Epilogue, a story that endures. Markus Braun's story is one of contrasts, brilliance and deception, innovation and collapse. Whether he is remembered as a visionary or a villain, his role in the Wirecard saga ensures that his name will not be forgotten. Wirecard may be gone, but its lessons endure. For Braun, his fate lies in the hands of the courts. The fight to clear his name or confront his culpability goes on, ensuring that his story remains one of the most gripping corporate sagas of the 21st century. But for the millions affected by Wirecard's implosion, the scars remain, a stark reminder that even the brightest stars can burn out spectacularly. While Wirecard's collapse exposed the fragility of traditional payment systems, our next story takes us deeper into the digital frontier. From conventional fintech to cryptocurrency, we're about to witness how another tech visionary's empire crumbled overnight. Markus Braun's collapse exposed the fragile line between innovation and illusion, shaking the foundations of global finance. But if Wirecard's implosion revealed cracks in traditional banking, the next story would send shock waves through the new frontier of money, the digital revolution of cryptocurrency. Meet Sam Bankman-Fried, the crypto wunderkind who promised to revolutionize finance, but instead orchestrated one of the largest digital asset frauds in history. Sam Bankman-Fried, the meteoric rise and catastrophic fall of Sam Bankman-Fried. He promised to democratize finance, but instead, Sam Bankman-Fried orchestrated one of the largest financial frauds in history, a promising start. March 5, 1992. In Stanford, California, Sam Bankman-Fried, or SBF as the world would later call him, was born into a family of intellects. Sam seemed destined for greatness. His parents, both Stanford law professors, nurtured his curious mind in an academic bubble. From an early age, SBF displayed an uncanny knack for numbers, a talent that would later catapult him to stardom and notoriety. At MIT, he honed his mathematical brilliance, graduating in 2014 with a degree in physics and a minor in mathematics. Armed with a sharp mind and a desire to conquer the world, he joined Jane Street Capital, a prestigious Wall Street trading firm. At Jane Street, SBF cut his teeth on the complexities of finance, and mastered the art of financial markets, specializing in arbitrage trading, a skill that would shape his future ventures. By 2017, he co-founded Alameda Research, a trading firm that sought to exploit inefficiencies in the nascent cryptocurrency market. SBF famously spotted an opportunity to arbitrage Bitcoin prices between Japan and the US, raking in millions in the volatile world of cryptocurrencies. But corporate life wasn't enough. SBF had bigger ambitions, building the crypto empire. In 2019, Bankman-Fried launched FTX, a cryptocurrency exchange that promised a user-friendly, innovative platform for global traders, professional and retail traders alike. From offering innovative products like tokenized stocks to allowing high-leverage trading, FTX quickly gained traction. Within 2 years, it was valued at $32 billion, thanks to sharp marketing ranging from celebrity endorsements to naming rights, to arena in strategic alliances and partnerships with major investors. FTX quickly became a titan in the industry. SBF was celebrated as a financial genius, a self-proclaimed advocate for effective altruism. He pledged his fortune to global causes and projected an image of a billionaire who cared more about saving the world than amassing riches. Media outlets hailed him as such, the White Knight of crypto, a rare figure who combined wealth with a mission to do good. Cracks in the maze of complexities behind the scenes, trouble brewed. Alameda Research and FTX were deeply intertwined in ways that few understood. Despite public assurances that the two operated independently, the reality was far murkier. There were blurred boundaries and a sharing of funds in secretive and questionable ways. Alameda used customer deposits from FTX to fuel its high-risk trading strategies, an arrangement concealed from investors and regulators alike. The house of cards began to wobble in November 2022. Binance CEO Changpeng Zhao, a rival and early investor in FTX, announced plans to liquidate Binance's holdings of FTX's native token, FTT. The announcement sent shockwaves through the market, sparking a bank run on FTX as panicked customers scrambled to withdraw their funds, revealing a liquidity crisis at FTX. As the withdrawals mounted, FTX's precarious financial structure was exposed. On November 11, 2022, FTX, Alameda Research, and over 130 related entities filed for bankruptcy. The staggering scope of the disaster unfolded. A staggering $8 billion shortfall in customer funds were unaccounted for, with evidence pointing to SBF using these funds to cover Alameda's losses, make political donations, and even finance luxury properties in the Bahamas. The arrest. In the wake of FTX's collapse, regulators and law enforcement quickly closed in. Bankman-Fried's downfall was swift. On December 12, 2022, Bahamian authorities arrested Bankman-Fried at the request of the U.S. government. His luxurious penthouse lifestyle in the Bahamas came to an abrupt end as he was extradited to the U.S. to face 7 federal charges, including wire fraud and money laundering. The indictment alleged he had misappropriated billions of dollars in customer funds to prop up Alameda Research, fund lavish real estate purchases, and make over $90 million in political donations. Once a symbol of crypto innovation, SBF now stood accused of orchestrating one of the largest financial frauds in history. Released on a $250 million bond, the stage was set for a high-stakes trial which became a global spectacle, the trial of the century. October 3, 2023, the battle began in a Manhattan courtroom in New York. The trial captivated the public, with daily headlines dissecting the courtroom drama. Was he a calculating fraudster or a misguided visionary? Prosecutors painted SBF as a manipulative mastermind of fraud who architected the funneling of billions in customer assets into risky ventures and personal gain. They revealed emails, chat logs, and financial records that detailed how customer funds were funneled into Alameda and used as a personal piggy bank. His defense argued he was a brilliant but overwhelmed entrepreneur, a young man who bit off more than he could chew and got caught in the chaos of managing a growing empire. They stated he didn't act maliciously, but had simply made poor decisions under immense pressure. However, the jury didn't buy it. On November 2, 2023, Bankman-Fried was convicted on all charges. The verdict will go on to cement his fate as a tale of unchecked ambition and ethical compromise. The sentence. In March 2024, SBF was sentenced to 25 years in prison and ordered to forfeit $11 billion. For the once celebrated billionaire, heralded as the savior of crypto, his empire and reputation were gone, leaving a legacy of broken trust and financial ruin in an unregulated industry rife with speculation and risk. SBF's rise and fall is no doubt one of the most dramatic stories in modern finance. A modern tragedy, a meteoric rise followed by a catastrophic fall. For his victims, the damage was profound. Thousands of customers lost their savings, and trust in the crypto market was shattered. For regulators and policymakers, the scandal became a rallying cry to impose stricter oversight on digital assets. For the world, the story of Sam Bankman-Fried is a modern parable about the dangers of unchecked ambition and the thin line between genius and fraud. As the cryptocurrency world continues to evolve, the ghost of FTX will always loom large. Bankman-Fried's name will forever be synonymous with one of the greatest financial collapses of the 21st century. A reminder that even in a world of innovation, the timeless lessons of accountability and ethics still apply. From crypto's digital wasteland, we move to another tech titan's fall from grace. If FTX showed us how new technology could be weaponized for fraud, our next story reveals how one CEO manipulated time itself. Meet Sanjay Kumar, the man who created the 35-day month and turned computer associates into a tale of Silicon Valley excess. Kumar orchestrated a fraud so audacious it defied the very concept of time. With an innovative twist, he didn't just manipulate numbers, he created a 35-day month. What does a 35-day month mean? And how did it cost investors billions? Let's unravel the story of Sanjay Kumar's desperate gambit to keep his empire afloat. Sanjay Kumar, the 35-day month fraud. What if months had 35 days? For Sanjay Kumar, this creative accounting trick brought in billions until it didn't. The rise, ruin, and reflection of Sanjay Kumar. Sanjay Kumar's life is a tale of ambition, betrayal, and the crushing weight of consequence. Born in 1962 in Sri Lanka, his early years were shaped by the instability of civil unrest. By 1976, his family made a desperate choice to leave everything behind, immigrating to the United States in search of safety and opportunity. For a teenager starting over in South Carolina, the challenges were immense. A new culture, a foreign language, and the weight of his family's hopes resting on his shoulders. Yet Kumar thrived, eventually attending Furman University in 1980. But in 1983, Kumar made a bold decision to leave college and chase his future in the rapidly evolving tech industry. Little did he know this move would propel him to extraordinary heights and bring him crashing down. The Ascent, a visionary leader. Kumar's brilliance quickly became evident when he joined Computer Associates, CA, in 1987. Barely in his mid-20s, he was thrust into a fast-paced world after CA acquired UCCL Corp, where he had worked only briefly. His sharp intellect and visionary thinking earned him quick promotions. Within a year, he had relocated to California's Long Island headquarters, marking the start of his rapid rise. By 1994, at just 31, he became president and COO, taking the reins of a company at the cutting edge of enterprise software and earning a reputation as a bold strategist who could steer the tech giant through shifting industry tides. When he took over as CEO in 2000, succeeding his mentor Charles Wang, it felt like the culmination of a classic American dream, a young immigrant reaching the pinnacle of corporate power. Under his leadership, Kumar was praised for reshaping CA's culture, making it more customer-friendly and forward-thinking. But behind the accolades and polished success story, cracks were forming. The conflict, shadows of deception. For all his accomplishments, Kumar's tenure came at a cost. Unbeknownst to the public, California's meteoric financial success was built on a foundation of manipulated numbers. An accounting scheme known as the 35-day month allowed the company to falsely inflate revenues, deceiving shareholders and regulators. In 2004, the truth began to emerge. Federal investigators uncovered the fraud, Though Kumar orchestrated a cover-up that involved lying under oath about the 35-day month and other frauds and trying to buy the silence of a potential witness, despite his denials, resigned as CEO under mounting pressure. He took a lower-profile role as chief software architect, but his days at CA were numbered. Just weeks later, he left the company entirely as the storm brewed, as prosecutors sharpened their focus. By 2006, the walls closed in. With 15,000 employees worldwide, CA Inc. was the world's fifth largest software provider. Kumar stood in court as a man stripped of his once glorious reputation, pleading guilty to obstruction of justice and securities fraud. The odds were devastatingly against him. The man who had once commanded boardrooms now faced prison walls. The fall, a reckoning. "I stand before your honor today to take full responsibility for my actions," Kumar said during his sentencing in 2006. His voice trembled, not with defiance, but with the raw acceptance of a man who knew he had failed. Not just himself, but his family, his employees, and the shareholders who trusted him. The court sentenced him to 12 years in federal prison and ordered him to pay $8 million in fines and nearly $800 million in restitution. It was a staggering fall for a man who had once been hailed as a visionary leader. Yet Kumar did not go quietly. In court, he alleged that his mentor, Charles Wang, had orchestrated improper accounting practices for years. He claimed that board members, including a former U.S. senator, had knowledge of the fraud. These revelations added another layer of betrayal to an already scandalous saga, suggesting that Kumar was not alone in the scandal, but he was the one paying the price. The isolation, prison, and reflection. Prison was a humbling chapter for Kumar. It stripped away everything him had built: his wealth, his reputation, and his freedom. For over a decade, he lived among men with whom he had little in common, grappling with the consequences of his actions. The man who once wielded immense power lived among the incarcerated, a stark reminder of the consequences of unchecked ambition. It was a far cry from the opulence of corporate boardrooms, but prison gave Kumar time to reflect. The man who had once been consumed by ambition now faced his own humanity. His story became a cautionary tale, a reminder that the pursuit of success, when untethered from ethics, can lead to devastating ruin. The redemption, a long road. Back on January 25, 2017, Kumar walked out of federal prison, a free man for the first time in 12 years. But freedom did not erase his debts. He owed nearly $800 million in restitution, and the government would take 20% of his future earnings. Kumar emerged into a world that had moved on, one in which his name was no longer synonymous with success, but with scandal. For many, his story ended with his release. But for Kumar, the journey to rebuild, if not his reputation, then his humanity, was just beginning. The legacy. Sanjay Kumar's story is neither pure triumph nor complete tragedy. It is the story of a man who climbed too high, too fast, and fell hard. It also tells us of resilience, of a man who, despite losing everything, found the strength to face his mistakes. What Kumar's future holds remains uncertain. His life reminds us that ambition, when unmoored from integrity, can destroy even the brightest stars. Yet it also shows that no fall is final, and no journey is without the hope of redemption. How much they stole: $2.2 billion. How they got caught. The New York Times reported on accounting tricks used by CA in April 2001, which triggered an investigation. The FBI also investigated possible accounting fraud at CA in February 2002. SEC investigations revealed backdated contracts and suspicious accounting practices. Kumar was sentenced to 12 years in prison and fined $8 million in November 2006. He was released in 2017. Do you think Kumar's former boss and Senato D'Amato knew about his accounting fraud? Let us know in the comments. 3 tech visionaries, 3 digital empires, 3 spectacular falls from grace. But while these men manipulated the digital realm, our next episode takes us into the world of telecommunications, where corporate titans built empires on copper wire and fiber optics, only to see them crash in a tangle of lies and deceit. Join us next for Telecom Troubles as we uncover how Bernie Ebbers and WorldCom changed the face of corporate fraud forever.